Hello traders, this is Blake Morrow with ForexAnalytix, and you're listening to the week ahead video for June 10th, 2018. I hope you guys and gals are having a great weekend. Now, before we get into what's going to be a very important week next week, before we get into the analysis of the charts, I've got to mention, if you haven't used ForexAnalytix, you haven't tried it out yet, even if you have, you should try it again. Because it's only $1 for 10 days, and all you have to do is click the sign up button right here in the middle. Once you sign up and you get logged in, you will see this page, and you can download our mobile app, get everything, all of our analysis as it comes out, push to your mobile device, whether it's on Android or iOS. You know, I even have an iWatch. So the notifications actually come to my wrist as well, which is really cool, especially when I'm driving around and my phone's in my pocket. So make sure you guys download the app when you do that. Now, the one other thing I wanted to say is this is the current iteration of ForexAnalytix, what you see right here. This is the new version, which is in beta. Okay, and this version that you see here that's in beta, this one's going to be released, we hope, on Wednesday of this week. Now, I tell you all this, and I want you to hear this carefully, because we offer, from a company standpoint, probably the best technology in any type of analysis you're going to get, and we offer it substantially less than the competition, whatever the competition may be. Anybody that offers this type of analysis to the markets, the prices are significantly higher than where we're at. And usually you're just at some sort of web page that updates when you refresh the screen. Everything here is dynamic, and we have live quotes. And but I'm going to tell you that our prices are going to be rising here in the coming weeks ahead to get closer to where the competition is at, but still stay below them. And we've managed to do this pretty effectively over the last year and a half. But our prices will be rising. With that, if you're currently using ForexAnalytix from here on out, or whenever before we raise those prices, you're going to be grandfathered in. As long as you're a subscriber, you're not going to pay higher prices. So that's great news for you. I just wanted to be very clear on that, because as a company, we have decided that after spending so much money in technology and development over the course of the last, especially in this latest iteration, we are going to have to raise our prices a little bit. But again, if you're using it at the current price, you don't have to worry about that. And we'll give you a little bit of notice, but not much. So if you're heading out for summer break, you're heading out for vacation with your families, or you're just taking a break from trading, keep that in mind as we move into the summer. All right, guys and gals, so let's talk about, first of all, let's talk about last week a little bit. I don't think I need to harp too much on what we've been seeing, other than if you look at the euro dollar and what's been happening over the last week, is we have this inverted head and shoulder pattern that the neckline, if you can't see it right here, it's about 117.40, 117.50. The good news is, if you're long the euro, which I'm currently not, but that doesn't mean I don't want to be, is that we tested the neckline and we respected the neckline of the inverted head and shoulder pattern. Now, the target of the inverted head and shoulder pattern actually reaches to 120, or the 200-day moving average. Because if you take the lows here at 115 to 117.50, that's 250 pips roughly. You add 250 pips to 117.50, that takes you to 120. All right, so roughly a rally is still in store for the euro, and technically we're actually holding this trend line. We tested it on Thursday. You can see right here we tested it on Thursday. I meant Friday. We tested on Friday and we respected it, and we actually closed the day higher. And if you were using ForexAnalytix, you were actually notified when we were testing the breakout point. Okay. Now, the reason why I point this out is because we are going into a very important week next week. Now, there's also I must say we're halfway through the weekend actually that I'm filming, and there's been a ton of notes that I've been reading through as far as the G7 talks that have just transpired with obviously the G7, and the talks about tariffs and trade imbalances, and and actually I'm gonna say frankly, some very mixed signals came out of that meeting, because as President Trump was leaving to head off to Singapore to potentially meet the leader of North Korea, he said, well, what about a world where there's no tariffs anywhere, on any side, a tariff-free world? And that I'm really not too sure how the market's going to interpret the mixed signals that we got from the G7 meeting. But it should be an interesting open on Sunday. Like I said, I'm not 100% sure how the market is going to open on Sunday, but it should be rather interesting. As far as technically where we're at in the dollar still looks like it's on a weak footing, and it looks like the euro can continue to recover. Now that takes us into what is happening next week. Next week we have the FOMC meeting, which happens on Wednesday, and then we have the ECB meeting, which happens on Thursday. There has been plenty of talk this last week, and one of the reasons why the euro is substantially higher this week is because there were a lot of, first of all, hawkish comments from already ECB hawks that came out, but the day before, there was some undisclosed. It's always undisclosed. I don't know. Always undisclosed. I'm going to tell you something, but you can't tell them who's telling you. So undisclosed sources that said that the ECB is going to have live debate about ending their version of quantitative easing, or ECB purchases, and that sparked some very bullish moves out of the euro going into midweek, into the end of the week. Now the euro did pull back a little bit on Friday, but like I said, it respected some major technical levels, and that's important to know, because as we go into next week, I don't know if I'm expecting a hawkish FOMC meeting. I'm expecting the FOMC to maybe even give us a slightly more dovish stance. And if the FOMC is slightly more dovish, especially in the dot plot arena, where they're placing their expectations on future hikes, and the ECB is hawkish, we might see a continuation higher in the euro dollar. And really what I'm focusing on is, as long as the euro hangs out above like 117 and we close above 117, I don't think I have any reason to be bearish the euro in the near term. Now that doesn't mean I won't be bearish the euro when we get to 120, because that would be a different story. But I do think that the euro dollar still looks very constructive from a bullish standpoint. Now that brings me to let's take a look at the pound dollar. The pound dollar, very similar situation. You'll notice that the pound it has this similar inverted head and shoulder pattern, and we had a double top. Oh, whoops! Let me go the other direction. Here's the weekly chart. You can see there's a double top here. False breakout to the upside led us to a breakdown. That was we've been talking about this for weeks. Obviously, if you've been listening to the week ahead video, we didn't quite complete the double top, which does make me a little nervous. However, the rounded bottom that the pound has been developing over the course of the last, you can see it here through those lows here. The rounded bottom and now inverted head and shoulder pattern is pretty clear, despite a lot of the headlines, the Brexit headlines that we were hearing about Theresa May and conditions and whatnot going into the end of the last week. The pound still held up pretty well. I think we do need to break back above. You can see this dotted line here. Remember, from several weeks ago, 134.50 is actually 134.40 was really critical support, and then once we broke it, the bottom fell out. We dropped 200 and some odd pips. Now we've been testing that on Thursday and Friday, and I think a real clean break above 134.70, 134.80 will open up the ability for the pound to make a move back to 136. And I think any move up to 137 which is previous support here, will be looked at as a selling opportunity. It's kind of like if the euro gets back to 120, yeah, if the cable gets back to 137, both are areas that I'm very interested in looking at shorting. But for right now, I'm actually looking more for dollar weakness than dollar strength. And with the trade talk contentions, the contention bleh, excuse me, the contentious talks about trade, I don't think that's going away. And I think that the dollar may reflect negatively as a result. But again, you kind of look at the euro dollar. If it stays above 117, if the cable, you know, continues to trade above 133, I think that further upside is probably warranted in these two particular pairs. Let's look at the Aussie now. The Aussie dollar. This throws a little monkey wrench in my idea of okay, I want to continue to short the dollar, because I look at majors like the Aussie. I don't know. The Aussie failed this week. It really did. You can see how we failed right at the underside of this multi-year broken trend line. You can see it right through here. We failed at 77 cents, and I was a little nervous that the Aussie wasn't breaking higher above 77 cents as copper was rallying. If you follow me on Twitter, I did make note of that on I think it was on Wednesday or Thursday, that it looked bullish, but you know, copper continued to rally, and actually, if you look at copper here, let me see if I can just take you over the chart really fast. Copper's made a really strong move, huge move out of this triangle this last week. But why hasn't the Aussie responded? And that to me is a little worrying. Now, that doesn't mean that the Aussie can't go higher. It's just, you know, I think this is going to be really, really critical resistance. And while we're trading below 76.70, 76.80, I have a hard time being bullish the Aussie. Now, you could play that different ways. You don't have to play the Aussie dollar. You could say, well, you know, if the euro looks a little bit more bullish, but the Aussie looks heavy, well, you can just, you know, trade the euro Aussie on the long side, right? Yeah, I mean, you know, right now, the euro Aussie has been beat down, but look, we posted an outside day, this daily candle. We get back above one, or that's an outside week. Let me get over to the daily. The daily candle, you know, we're struggling here at the 200-day moving average, but we get above 156, and this euro Aussie is going to squeeze the heck out of shorts. I mean, we've had a nice run from 161 to 153 over the course of the last month. What's to say that we can't rally back above the 200-day moving average above 156 and squeeze back to 158 or 159? So again, it throws a little bit of a monkey wrench in my idea of okay, maybe we're going to see broad-based US dollar weakness. We may not be. You might have to be a little bit more selective on how you're trading the dollar versus just you know, shorting the dollar against a basket of currencies like the euro, pound, Aussie, Kiwi. You know, you might have to be a little bit more selective, or maybe even better yet, play a cross rate if you don't even want anything to do with the dollar. Okay, that's another idea, especially because the dollar is, you know, looks kind of range bound at this moment. I would say, you know, over the next several weeks, intermediate type of time frame. Another big chart that I need to show you, the Canadian. The Canadian, look at here, let's go over to the daily. Look at the triangle that we're forming. Okay, we really rejected 130.50. That is a big multi-year trend line, you know, from 2016 down. Okay, it's really key resistance. If the U.S. pieces together a NAFTA deal, whether it's, you know, bilateral or not, with Canada and or Mexico, the fact of the matter is the US dollar Canadian will probably come down. The Canadian would benefit from that. So you see this tight consolidation here on the weekly chart. I think a breakout is really coming in the dollar Canadian. It's coming soon. I am looking at 128.50 and 130.50. That's it. You know, 128.50, which is right here. 130.50, which is basically right here. Soon price action is going to tell us which way the market's going and which way the market's leaning. So I think you have to be very patient. It's been extremely volatile. If you were on the face webinar with us on Friday as we were live in the markets, I tried to short the US dollar Canadian at 130.30 and I missed it following the jobs report out of Canada. I'm a little bummed out because, you know, obviously we dropped 100 pips from that moment that I tried to short it. You can go back and listen to the YouTube video from Friday if you want, if you're subscribed to our YouTube channel. But I tried to get it, I just couldn't get off a trade. It was moving a little too fast, and obviously it continued to drop quite aggressively. But I think the dollar Canadian, again, we're confined, but a breakout is really looming here. One last thing, well, actually two things I want to leave you with. I don't want to make this video too long, but I want to talk about just a couple other things. The US dollar Canadian, or excuse me, the US dollar Japanese yen. I have been trading this on the short side. It really paid me very well this week. We failed at the 618 retracement, which is above 110.15, and I was short around 109. I want to say 109.85 was my average. I did pretty well with it because I was kind of trading around a core position. I was more short the euro yen than anything, and did really well shorting the euro yen, which I can also show you that as well. But I think this you know, might be setting up a head and shoulder pattern. The fact of the matter is we came out of a descending wedge and we failed at the 200-day moving average, which is right here at 110.15. So that really, you know, leaves us, you know, more downside available, or potential, excuse me, longer term. And I think if the market signals maybe a little risk off, that might be the case. And the euro yen, I just really shorted the failure here at the 130 level. You can see it right here. If you were using ForexAnalytix, you got notified. As we hit the pairs testing a trend line and the 78% retracement, you can see it right here. I'm reading it to you. At the 78% fib and the 48 EMA on the 4-hour chart, this is a good risk reward short with the stop loss above 130.50. Alongside the 78% retracement as noted as above, we're hitting the 618. And that really, I mean, we failed there pretty aggressively. You can see here, this was as it was happening. And then if you can see what happened following that, let me go back over here. That's what happened following it. And I did fairly well with the euro yen on the short side at the end of the week. So that's how I've been playing the yen. Now, one last thing I want to talk about, because I said there's two, and I didn't want to bring up the euro yen, but it just kind of got thrown in the conversation. Let's take a look at the 10-year bond market. The 10-year bond market, this descending wedge, you know, you've been very well informed that we were going to see some sort of reversal out of the 10-year over the last several weeks. If you listen to these webinars, every single, you know, the week ahead videos. All right, we came out of that descending wedge. Dale Pinkert, he thought we'd make one more drive lower. We did. Then and I agreed with him that we'd come through that lower trend line. We reversed. We squeezed heavily when I was on vacation actually last week. We came down, retested the trend line, and the bond market still looks constructive for a break higher. And I still think ultimately we're going to 122 or higher, maybe the 200-day moving average, before this is all said and done. That means yields are going to come off this 3% or 295 wherever we closed on Friday. We may, you know, yields may come back down towards 285, 280, 2.80, and that means the 10-year bond market may rally towards 122. That may coincide with some risk aversion in the equity markets, but you know, I look at the equity markets; they're pretty bulled up right now. Again, how they respond to the events that happened over this weekend and how the central banks are going to meet next week are going to be ultimately the most important thing for the stock market. But as a reflection, the bond year, or the bond market could firm as a result. And I think while we stay above 119, you have to be on guard for potential higher rally in the bond market. That means lower yields, which ultimately means probably a lower US dollar Japanese yen. Guys and gals, I hope you're having a great weekend, and really I hope if you love this video and you think it's going to benefit you going into next week, you click on the like button. You could see it on the little, you know, on YouTube, there's a little thumbs up. Click that thumbs up, and then there's a bell notification. If you click that, That means any video that we publish, you're going to get notified, usually on desktop notifications. And also subscribe to our YouTube channel, because this way you don't miss all the great interviews that we do throughout the course of the week, and you don't miss any of the analysis. If you happen to not be in front of your computer, we publish it maybe 3 or 4 hours later, and you can listen to what we had to say earlier that day. But guys and gals, thank you so much for listening in. I hope you're having a great weekend, and I hope you have a great trading week next week. My name is Blake Morrow with ForexAnalytix. Thanks for listening in.